I noticed that your S&P 500 target is below where we are right now, at least for this year, not for next year, but for 2021. Why is that? And obviously, what do you expect then the rest of the year?
That's right. We're still bullish on the economy, economic growth, and think this could be a good period for the U.S. overall. But for the market, we've seen last year a lot of the gains were led by multiple expansion, the S&P 500 PE ratio expanding. Now the earnings are coming through, and it's been a very strong first half for earnings, exceeding expectations in a big way. But equity sentiment has grown very euphoric, but based on the measures that we track, valuations, as mentioned, are very elevated. And, I think there's risks from here. Corporate margins have held up very well, despite a lot of the mentions of inflation so far. But those inflation mentions, especially labor and supply chain, have started to skyrocket on earnings calls. And that could be a headwind in the second half. And, if the Fed starts to taper later this year, the fact that a lot of the Fed liquidity-induced market gains that we've seen post-crisis, that could slow. So the fact that the Fed could be tapering and based on the Fed balance sheet, we've calculated that this could suggest pretty limited upside to the S&P 500 through the end of next year. So downside risk in 2021. Next year, we think there could be some recovery, but we're still looking for pretty modest gains to the market, and see better areas within equities right now than just buying the S&P 500 overall.
I know those better opportunities I would imagine, in the small and mid-cap space, which are more tied to the U.S. economy, less tied to ETFs. And if so, where in particular, Jill, do you see more opportunity?
That's right. The S&P 500 large cap index has grown very concentrated, obviously, in a lot of the, mega cap growth stocks, and, aren't as sensitive to the overall backdrop of a strong U.S. economy. So if provided we don't see a further, surge in COVID cases and a weakening macroeconomic backdrop, we would expect that small caps could do well. They did very well earlier this year. We saw a bit of a pause and pullback, and we started to see some outperformance again starting in mid-August. So the size segment is very tethered to CapEx spending. Typically, if you see CapEx, infrastructure, even the U.S. reshoring story, CapEx. Small caps tend to fare better than larger stocks in this backdrop, and they're more tethered to services spending. The other thing is that they're still, based on where valuations are, relatively inexpensive versus large caps, and so valuation doesn't tend to tell you much about what happens in the short term. But over the long term, valuations for small caps would suggest we could still see gains if you're a long-term investor with a 10-year time horizon. Whereas for large caps, our valuation framework is pointing out that you could see slightly negative annualized returns over the next 10 years. And that's the first time our models have been saying that since 1999.
It's the first time I've heard that. I mean, big investors in big stocks don't want to hear that, but at least you're saying there's opportunities in the smaller way. Jill, is it just buy smaller mid-cap ETFs and let it roll, or are there groups of stocks within smaller mid-cap that you think will outperform even that group as a whole?
I think within small caps, a lot of the more cyclical areas still haven't been necessarily pricing in the recovery that we've seen. So some of the more economically sensitive sectors within small caps have tended to look attractive in our work. And I would say even beyond small caps, within the large cap equity market, we do still see some opportunities. So within the S&P 500, we would stick with inflation protected yield. So given the low rate backdrop that we're still in, but the fact that inflation has been rising, we think you want to look for stocks that have, offer healthy yields, but growing dividends, and in sectors that can benefit or not be hurt by inflation. So areas like energy and materials, financials has seen very, very healthy cash return and has been growing dividends, even parts of real estate. So we think there are opportunities within the market, but certainly more selective pockets at this time.